Okay, so welcome to BA 334. I think it's either called Taxation of Corporations or Corporate Tax or something to that effect. A little bit of a misnomer, by the way, because um, as the title of the book by Spilker indicates, this is really more about taxation of business entities. Which includes corporations, but it includes other types of business entities as well, as you will see. And in chapter 25, we actually talk about um, trusts and estates and gift tax, which is, I guess, somewhat peripherally has to do with business entities, but it may not. It may be individuals. So, anyway, that's the kind of the gist of what we're going to cover this term. So this is your typical introductory chapter, entities overview. So let's take a look at it. So here are your learning objectives, not very many. And most of you have probably already seen some of this in probably legal environment of business or business law or whatever it's called. So, and we won't spend a lot of time on the non-tax characteristics because this is a tax class and you've probably already seen this stuff anyway. So anyway, there's 4 or 5 business entities you can have. Certainly a corporation. Um, as you can see, there's actually 2 types of corporations. Limited liability company, general partnership, limited partnership, and sole proprietorship. And, you know, when you're setting up a business, you have to think about the legal ramifications, but you also have to think about the tax ramifications. Of course, there's always cost as well, so there's a lot of things to think about before setting up a business entity. But at least as far as these entities are concerned, how do you set them up? Well, for a corporation, you have to file what are called articles of incorporation, usually with the Secretary of State in the state that you want to be incorporated in. You have to pay a filing fee. You have to usually make sure the name that you're going to have for the corporation doesn't conflict with any other names already on their list of corporations, things of that sort. But it's mainly filing the articles and paying a fee. For the LLC, pretty much the same thing. They have different terminologies. Here it's called articles of organization, but it's basically the same thing. For a general partnership, you really don't have to do anything other than essentially come up with either an express agreement or an implied agreement to enter into a partnership with at least one other person. And a limited partnership, and again, is it good to have a written agreement? Yeah, it's definitely not a good idea to do anything on the fly without some agreement of what everybody's rights and obligations are. But I've seen cases where You can enter into a general partnership by and not even know it. There's case law out there that says you can enter into an agreement uh, even if there's no explicit agreement for a partnership. Um, you can have a limited partnership. Of course, even with a limited partnership, you have to have at least one general partner, somebody to sue. And so usually for a limited partnership, you also have a written agreement, but again, you don't have to. Uh, but you usually have to file what's called a certificate of limited partnership with the state as well. And I'm pretty sure there's a fee for that. Um, Certainly, articles of organization under LLC, there's a fee for that as well. Sole proprietors really don't have to do much of anything. You could wake up one day and say, hey, I think I'm going to do X and make money at it, and go do it, and you're on your way. Now, some counties, some uh, municipalities might require some sort of registration of what your DBA is. DBA means you're Joe Blow doing business as Joe Blow Plumbers, or whatever. But really, there's no formalities, real formalities involved in uh, operating a sole proprietor. Well, one of the main things to consider in setting up a business entity is how liabilities are going to be handled. And for corporations and LLCs, um, those things are separate legal entities, okay? And so because they are separate legal entities, liabilities that are entered into in the name of the corporation or the LLC are owed by the corporation and the LLC, and not the individual either shareholders or members for an LLC. Essentially the same thing. They own shareholders own a share or shares in a corporation, so they have an ownership interest in the corporation. For LLC, they're called members. Basically the same thing, though. But those shareholders or members are not responsible for the debts of the corporation or LLC. Now, much different for partnerships. If you are in a general partnership, you've got at least two general partners. You have no limited partners. All the general partners are responsible for the debt of the general partnership. Now, again, like I said, each state requires that a limited partnership have at least one general partner that will be responsible for the debt of the limited partnership. And usually the general partner is the managing partner as well for the limited partnership. But as the connotation indicates, these limited partners have limited liability, meaning any debt incurred by the general partner in the name of the limited partnership is not the responsibility of the limited partners as long as they don't do certain things like try to manage the partnership. So they have to be very hands off. Now, the sole proprietor has it worse than anybody except maybe general partner. And so they are responsible for the debts of the business. Now, the way, and it says unless single member LLC. So what they're saying there is, and I see this, used to see this a lot when I was in private practice. I'd get either one or maybe a married couple or a couple of people who are in business together come in and they started this business maybe on the side, and it's gotten to be fairly successful, and probably a significant other has indicated to them that they needed to protect themselves from liability by creating one of these other business entities, either a corporation or an LLC. And so where it says individual owners are responsible, meaning sole proprietorships are responsible for the debts of the sole proprietorship, if they are a sole proprietor or if they are a general partnership, they probably need to look at incorporating or creating a limited liability company. You can have a single member corporation. You can't, or not single member, but single shareholder corporation. You can have a single member LLC and protect yourself from liability. Now, this part about rights, responsibilities, and legal arrangements among owners, if you are a corporation, let's see if this, well, doesn't really talk about anything. It's kind of a skimpy outline here, sorry. But I'm on page 15-3. And so for a corporation, you have to do certain things. You have to have a corporate book. You have to comply with bylaws. You have to set up the bylaws, comply with them, have board of directors, have regular board meetings, regular shareholder meetings, keep minutes, issue shares of stock, maintain a stock ledger, pay filing fees, pay corporate taxes, all kinds of things. If you're a limited liability company, essentially you have to do some minimum things. There's not as many things involved. Certainly you have to file your articles of organization with the state, but beyond that, you don't have as many responsibilities with the state. As far as between shareholders, you don't have a lot of flexibility there. You can't come up with a side agreement to change the rules between shareholders. Not so with LLCs. And so members of the LLCs have the flexibility to alter their arrangement by spelling out through an operating agreement management practices of the entity and the rights and responsibilities of the members. Also, with partnerships, they have flexibility. Now, again, there's some default provisions in state laws, but again, for LLCs and for partnerships, but not corporations, they have the flexibility to set up the rights and obligations of the partners or members however they want. Of course, the good thing about corporations is if you want to go public, that's usually the way to go, is have a corporation. In limited circumstances, you can do it with a limited partnership, but very limited. All right, so this kind of summarizes some of the things we've talked about. All right, let's talk about entity tax classifications. Okay, so note here the first sentence of page 5, 15-5. A business's legal form may be different from its tax form. And so for tax purposes, business entities can be classified as either separate tax-paying entities or what we call flow-through entities. If you want to be a separate tax-paying entity to pay tax on your income, you can do so. If you want to be a flow-through entity, that flow-through entity will not pay taxes because the income flows through to the owners who are responsible for paying tax on the income. So the question is, how do you determine whether a particular business entity is treated as a separate tax-paying entity or a flow-through entity for tax purposes? Well, it's referred to as check-the-box regulations. And so under check-the-box regulations, entities that are legal corporations under state law or are, by default, treated as C corporations for tax purposes. C corporations report their taxable income, and if you are a C corporation, you are taxed as a separate legal entity, separate from its owners, okay? And when it's talking about a C corporation, it's talking about subject to the tax provisions of subchapter C of the Internal Revenue Code. And so C corporations report their taxable income to the IRS on Form 1120. Now, some corporations can be, if they elect to be, and if they qualify, what we call S corporations. If they qualify and elect to be taxed as a, well, if they elect to be an S corporation and they qualify, this permits the corporation to be taxed as a flow-through entity called an S corporation. They're subject to, guess what? Subchapter S of the Internal Revenue Code. And they report the results of their operations on IRS Form 1120S. Well, what if you are an unincorporated entity, meaning you're not a corporation of any type? You're one of those others. Well, by default, you're treated as a flow-through entity. However, owners of an unincorporated entity can still elect to have their business taxed as a C corporation instead of as the default flow-through entity. In fact, owners could elect to have the business taxed as an S corporation. And notice here, the non-tax considerations do not change because these elections do not affect the legal classification of the entity. So you can have one legal classification and have a different tax classification, and the two will not conflict. Well, so even a sole proprietor could elect to be taxed as a C corp or an S corp. Weird, huh? So yeah, that's the thing about tax. It's if I mean you obviously had to have um, taxation of individuals before you took this. So if you haven't found out before now, surely you're coming around to the fact that there's a lot of legalese and a lot of mental gymnastics involved in uh, the tax profession. That's why it helps to have a law degree. So here's kind of the IRS's little diagram. So you might want to go through this and make sure you understand it. So just so we're clear, and you may have seen this before. Um, flow through entities are not taxed at the entity level. The owners, the income, the gains, the losses, the deductions all flow through to the owners at their percentage of ownership, and they must recognize the income, gain, loss, deduction, etc., on their own tax returns. C corporations, totally different. They pay at the entity level. The income does not flow through to the shareholders, nor do the losses flow through to the shareholders. Losses for a flow-through entity flow through to the owners. If the corporation wants to distribute money to the shareholders under a C Corp, well, guess what? They're taxed again. Now, granted, you probably know this from BA 333, they don't get taxed at their marginal, the shareholders don't get taxed at their marginal tax rate. They get taxed on monies they receive from corporations as dividends. And so on those dividends, they would get taxed at either 0, 15, or 20, depending on their marginal tax rate. Now, for the tax rate of flow-through business entity, well, there is none for the flow-through business entity, but the tax rate on the income from the flow-through business entity is whatever the individual's marginal tax rate is, which in 2018 and on is top individual rate is 37%. And then there could be other stuff. On top of that, owners of entities taxed as partnerships and sole proprietorships who are involved in the entity's business activities are potentially subject to 3.8. What is the 3.8? Let's see. What is that? I'm drawing a blank. Oh, net investment income tax rate. Also, the 15.3% self-employment tax. There's also a 0.9% additional Medicare tax. So, but notice here for S corps, even if a shareholder is involved in the S corp operation, they are not subject to self-employment tax or additional Medicare tax on business income allocations from the S corp. So that's a good thing. You can look over this. I don't really cover this part of it, but you know we cover this stuff in somewhat in taxation of individuals, so you can look over this. But I am moving on. For C corporations, well, their tax rates have gone down quite a bit, and it's essentially a flat rate of 21%. To tell you the truth, that is why you see the economic boom that the nation is having right now, is because Congress reduced the tax rates for corporations. They now have more money to spend on capital projects. They have more money to spend on hiring you, paying you decent salaries, things like that. And so what you see after that, the second level of tax, is that tax that the shareholder has to pay when they receive dividends from the C Corp. On top of the dividend, paying taxes on the dividend, they may also be subject to the 3.8 net investment income tax as well. Usually that's for the higher marginal tax rates, though. Now, understand that a corporation can own, well, let's put it this way. A business entity, including a corporation, can own stock in another corporation. And that second corporation, if they pay dividends to the first corporation, they have to include the dividend in income, but they received what's called a dividends received deduction, and that uh, dividend received deduction is reduces the amount of the dividend that's subject to tax by either 50%, 65%, or 100%, depending on the extent of ownership in that second corporation, which is the distributing corporation. Now, there's some other rules for institutional shareholders, such as retirement, these big public employee pension organizations, tax exempt organizations, as well as foreign shareholders. All right, let's see. Oh, last but not least, and then I'm gonna take a break and come back at the second half of this in a few minutes. Um, Certainly, a corporation can avoid that second layer of tax to the shareholders by simply reinvesting or holding on to the cash and not paying dividends. But let's face it, if you're a public company, you want to pay consistent dividends of a certain amount, usually a percentage of earnings. So, you can only hold on to earnings for so long before the shareholders start to squawk. They consider that part of their investment or return on investment. All right, so I'll pick this up on the next slide.